Last October 15th was one of the most unbelievable days of trading in the market for U.S. Treasuries. The 10-year started the day at about 220, fell all the way to 186 within the span of about an hour, and then closed the day at 214. Now, this kind of thing is really difficult to explain, and to this point, nobody's been able to. I'm joined here today by Joe Rennison of the FT, markets reporter. Joe, today, American regulators, including the Fed and the Treasury, finally came out with a report that tried to get at what happened. Did they succeed, and what does the report say happened on October 15th?
So, sadly, there is still no smoking gun.
Then I'm leaving, right?
There are a number of potential reasons, a number of combining reasons as to what may have caused the sort of sharp moves on October 15th, but no specific answer as yet.
Nothing definitive. Okay, so what are some of the circumstantial possibilities?
So throughout 2014, especially at the beginning, hedge funds, investors built up big positions betting on US growth, on the fact that the Fed would raise interest rates. And then over the summer, that trade started to look not so good. Oil prices started to plummet, and a lot of hedge funds became a little bit nervous about that trade. Through September, some other kind of things start to unravel. A big bet on an investor lawsuit going through for Fannie Mae and Freddie Mac gets thrown out. On October 14th, in the evening, a potential merger between Shire and AbbVie, two big pharmaceutical giants, falls apart. Another trade that a lot of hedge funds and investors have kind of piled into. So when you wake up on October 15th, sorry, what you have is a bunch of people who are really nervous and want to run to quality, fly to quality, and it creates a huge demand for US Treasuries that spurs this kind of downward trajectory in yields, which move inversely to prices, and this kind of rapid spike back up, ending the day roughly, not too far off where they started, really.
So, okay, we start the day, pent-up demand for U.S. Treasuries, right? But what do we think might have actually catalyzed the thing? What actually sparked the big drop in yields that day? Because it was precipitous and it was fast.
So the spark that everyone points to is weak US retail sales data. But that, on a normal trading day, would not have led to what we saw. The kind of reason for the Treasury investigating this particular trading day is because it was so bizarre. And it's taken them 9 months to collect data on where people were positioned, what people were doing, and they've still come back, and they have a pretty good idea about the course of events, but still explaining exactly what and why it happened is proving tricky.
Anything else in the report jump out at you?
So there was one thing, and I think it's really interesting that the Treasury picked up on this. Certainly from conversations had around the time of October 15th, people said that this couldn't just be a demand for Treasuries coming from sort of hedge funds and asset managers. This couldn't just be a flight to quality. They said there had to be something else to make it so severe. And what the Treasury picks up on is an options positioning. Options allow you to buy, say, a Treasury at a future date for a pre-agreed price. And leaving some of the detail aside, effectively what it did is it put banks on the same, or some banks, on the same side of the trade as hedge funds and asset managers. And it meant that so when people were coming in trying to buy, banks wanted to buy as well, so they weren't able to give the price. Now, importantly, the Fed says that there's not really enough data to really back that point up, but they still bring it out as a market commentary, something they were hearing, something people were saying.
So 77-page report, still no answers, just a lot of kind of interesting circumstantial detail. So moving things forward, but we're not quite there yet. That's about how we'd sum this up, right?
Yeah, I don't think that's too unreasonable.
All right. Joe Rennison, FT Markets Reporter, thanks very much for being here. And you can read Joe's analysis of the report at ft.com.